Hi, I'm Roger Montgomery from Montgomery Investment Management and welcome to this week's Video Insight. Today we turn back to our Whiteboard series to talk a little bit about executive salary. It's in the press again, and not because executive salaries are too high. Long gone appear to be the days when Alan Moss received $33 million at Macquarie Bank. CEO salaries seem to be restrained now, and the average executive salary for the top 300 companies is about $2.5 million. That still seems very high to some of you, but it's not as high as it was. What's interesting though is the Gillard government's move on executive salaries. There's going to be legislation released which will require that companies have to clearly explain what the take-home salary was of their top executives, and companies will be required by law to claw back wrongly paid bonuses. But is this the problem? I think the problem's a little bit different. I reckon the problem's to do with the way CEOs are remunerated and the way executives are remunerated. Marking salaries or bonuses based on total shareholder returns is simply wrong. Companies can use shareholders' funds to buy back shares and boost salaries for executives whose salaries are marked to earnings per share, for example. What I'd like to do today is talk about one aspect of remuneration, the issue of options. What we'll do is demonstrate how an executive can earn $176 million of personal wealth from the issue of options without improving the profit of the company by 1 cent. So let's look over here. We've got a company with $10 billion of equity earning a 10% return on that equity or $1 billion profit. Now note the profit never increases. It stays at precisely $1 billion. The company has 100 million shares on issue and it's issued the executive with 1% of all of its shares on issue. So it's issued the executive with 1 million shares. Now what's interesting about this is that each of the shares have a strike price of $110, which is higher than the current price of $100 a share. You can see the company has $1 billion profit, 100 million shares, so the earnings per share is $10. If the share price is 10 times, the PE ratio is always 10, the share price is 10 times the $10, the shares will be trading at precisely $100. The company decides to appropriately allocate some of its capital to the buyback of shares. And so in year one, it buys back 10% of the shares on issue. And it does that every year, and you can see the shares shares on issue fall from 100 million to 90 million to 81 million and so on and so forth. What you notice is that because there are fewer shares on issue, the earnings per share rise. And the earnings per share rise, as the earnings per share rise, if the PE ratio remains constant, the share price rises as well. And as the share price rises, the options become in the money. The options now have value. And as the company continues to use shareholders' funds to buy back the shares, who's rewarded the most? The executive. By the end of 10 years, those options, which appeared to have very little cost to shareholders, being worthless at the time they were issued, are now worth $177 million, even though the company's profit has not increased by 1 cent. Executive salaries and remuneration is a very important topic for shareholders to understand. There are many issues regarding executive salary and there's no perfect answer. However, executives should be remunerated based on return on equity adjusted for the amount of debt taken on. They should also be adjusted for the number of shares issued. So keep a lookout for those things, and also be very, very concerned when executive salaries are based on total shareholder return and earnings per share growth. The earnings per share growth can go up even when return on equity is declining. ABC Learning Centres is a classic example of that. And total shareholders' returns, being the increase in share price or the change in share price, and dividends can change remarkably in the long run. So bear in mind that when they're based on short-term changes in share price, be very, very careful. Short-term share prices change all the time, and executives cannot influence short-term share prices. So they shouldn't be linking their salaries to fortuitous increases in share prices that they can't control. There are many issues, as I said earlier, when it comes to executive remuneration. And bear in mind, even companies like BlueScope Steel and Arium and Qantas, companies that I would never own in a pink fit, have gone up remarkably in terms of their market prices. But have the executives been responsible for that, or is this just some cyclical shift in fashion in the market that they don't control? I'll leave you with that thought, and I look forward to seeing you next week at the next Video Insight. Be sure to follow us on Facebook and Twitter, and look forward to seeing you soon.